All right, welcome. This is Trusted Academy, and my name is Caleb Mills. Today is April 23rd, and this past week we have been going over the Unincorporated Business Trust. So today we will jump right back into it. We have went over a brief introduction of the Unincorporated Business Trust. And then in Lesson 2, we went into Trustees and Governance. Lesson 3, we went into Legal Structure and Property Ownership. Yesterday, Lesson 4 was Beneficiaries and Enjoyment. And today, Lesson 5 will be Charitable and Duration Provisions. Okay. So we'll just go ahead and jump right into it today. I just want to give a quick update while I'm thinking about it. My email address, caleb@trustedacademy.net, is functioning. So I know yesterday I had made a statement about that. I do have it fixed, so that's up and ready to go. My website is in the motions of being completed, and I'm excited to bring this information to you in a more, it's educational, but I'm really excited about this LMS system. So, all right, enough about that. We will jump right into it. Well, I said that. For some reason, I'm not able to get that pulled up right now. We'll just jump on to the next lesson after that. It will be records and management. Let me give me a quick sip right here. Ooh, that's hot. All right, here we go. Records and management. Records and management is designed to help learners understand the vital role that accurate documentation and structured oversight play in the operation of the Unincorporated Business Trust, also known as the UBOT. At the core of this lesson is the principle that a trust's credibility and legal standing are preserved through diligent record keeping and financial accountability and proper management practices. Trustees are expected to maintain accurate records, which include the minutes of meetings, books of account, annual reports, and a beneficiary register. These records are not merely administrative formalities. They serve as the backbone of trust operations, ensuring transparency, supporting decision-making, and providing evidence of compliance with trust provisions. Another important aspect covered in this lesson is the concept of delegation and oversight. While trustees may appoint officers or managers to carry out specific duties and oversee daily operations, they cannot transfer or abandon their ultimate authority and responsibility. The structure allows for practical management flexibility while maintaining the integrity of trustee control. Learners will gain insight into how delegated authority operates in practice, the limitations placed on managers or officers, and how trustees retain oversight through supervision and documentation. The emphasis here is on balancing efficiency with accountability, ensuring that while certain roles may be carried out by appointed individuals, the trustees remain the central figures of authority within the UBOT. The third key focus on this lesson is financial management and banking practices. For a trust to operate effectively, it must establish banking arrangements under its own EIN or TIN, which ensures that accounts remain distinctly tied to the trust entity rather than to individual trustees or beneficiaries. This lesson highlights important banking principles such as selecting appropriate depositories, setting endorsement and signature requirements, and establishing clear rules for authorized signatories. These financial safeguards are essential to protecting trust assets from misuse or mismanagement and provide an organized framework for transactions. By completing this lesson, learners will understand the mandatory records required, the framework of delegation within a trust, and the banking safeguards that ensure long-term credibility and sound operation of an unincorporated business trust. Lesson 6, Records and Management. In this lesson, we'll explore how proper documentation, accurate record keeping, and effective management practices preserve the trust integrity. You'll learn why maintaining addresses, minutes, and trustee actions is essential for legal recognition, accountability, and smooth operation of the unincorporated business trust. Introduction. A trust is only as strong as its structure of accountability, and this accountability rests on three pillars: records, management, and banking. Without a reliable system for maintaining accurate records, defining clear management roles, and establishing proper banking procedures, even the most carefully designed trusts can face challenges such as disputes among beneficiaries, mismanagement of assets, or unnecessary financial risks. These elements are not optional. They are the foundation that ensures the unincorporated business trust operates with credibility and stability. The first area, records, is crucial because it creates a permanent and verifiable account of the trust activities. Documents such as meeting minutes, books of account, annual reports, and beneficiary registers provide evidence of decisions and financial transactions, helping prevent misunderstandings or allegations of misconduct. By keeping these records current and accurate, trustees not only fulfill their fiduciary duties, but also demonstrate transparency to all interested parties. The second area, officers and management, addresses the balance between the delegating duties and preserving trustee oversight. Trustees may appoint officers or managers to handle day-to-day operations, yet the ultimate authority always remains with the trustees. This system allows the trust to function efficiently by assigning specific tasks while ensuring that no individual can act beyond the boundaries of trustee supervision. Properly structured management supports continuity, reduces administrative burdens, and safeguards the trust from unilateral or unauthorized decisions. The third area, banking, ensures the trust's financial integrity by using accounts tied to the trust-owned EIN or TIN rather than personal identifiers. The trust maintains a distinct financial identity. Policies regarding authorized signatories, endorsement rules, and choice of depositories give trustees firm control over how funds are handled. This protects trust assets, ensures only approved transactions occur, and creates a system of checks and balances within the financial operations of the trust. Together, these provisions, records, management, and banking, form a comprehensive framework that protects the integrity of the trust. They not only support smooth daily operations, but also safeguard the rights of both trustees and beneficiaries, ensuring the UBOT remains strong, reliable, and accountable in all its dealings. Learning objectives. By the end of this lesson, you'll be able to recognize the mandatory records trustees must keep and why they matter. 2. Explain how trustees appoint and supervise officers or managers. 3. Understand the rules governing banking transactions and trustee signatories. 4. Appreciate the importance of transparency, oversight, and financial control in trust management. Maintaining records. This would be Article 16, Maintaining Records, Core Duties. Trustees' duty to maintain records. Trustees are both legally and contractually obligated to maintain accurate and complete records of all trust operations. This obligation is far more than an administrative formality. It is the core of accountability, transparency, and credibility within the Unincorporated Business Trust. Proper documentation ensures that the trust complies with the terms of its indenture while also reflecting responsible management. These records not only safeguard the trustees, but also reassure beneficiaries, banks, auditors, and regulators that the trust is operating in an orderly and trustworthy manner. The essential records include meeting records. Trustees must prepare and preserve the minutes in all meetings held with trustees and shareholders. These minutes capture the discussions, decisions, and resolutions that shape the trust governance. By keeping them in an organized manner, trustees establish a permanent record of major actions, which can prevent disputes and demonstrate transparency in decision making. Books of account. The trust is required to maintain detailed books of account that document every receipt and disbursement. These records form a complete financial trail showing how trust assets are handled and ensuring that no funds are unaccounted for. Accurate books of account protect the trustees against claims of mismanagement while giving beneficiaries confidence that their interests are being carefully safeguarded. Annual reports. At the close of each fiscal year, which ends on December 31st, trustees must prepare a comprehensive annual report. This report consolidates all activities and financial data into a clear summary of the trust's performance and overall condition. It serves as both a management tool for the trustees and a transparency tool for the beneficiaries. Beneficiary register. Trustees must also maintain a beneficiary register listing the names, addresses, and units of beneficial interest for each shareholder. This record ensures clarity in ownership, prevents conflicts over entitlements, and supports equitable distribution of trust benefits. Why it matters? Maintaining these records is a fiduciary responsibility that safeguards the trust's long-term stability. Clear and accurate records 1. Protect trustees by providing proper management and decision-making. 2. Build trustworthiness with beneficiaries through transparency. 3. Support financial integrity by ensuring assets are tracked and accounted for. And 4. enhance credibility with banks, auditors, and other third parties which may rely on these records. In short, good record keeping is the backbone of trust governance. It protects the trustees, secures the beneficiary's interest, and strengthens the reputation of the Unincorporated Business Trust as a reliable and well-maintained, well-managed entity. Importance of accurate records. Why record keeping is crucial in a UBOT. Why is record keeping so crucial in an unincorporated business trust? The answer lies in the fact that records are not just paperwork. They are the foundation of legal protection, transparency, credibility, and continuity. Accurate documentation ensures that every decision and transaction can be traced and justified. Without proper records, trustees expose themselves and the trust to unnecessary risks, disputes, and financial instability, even if they act responsibly. In practice, record keeping is what transforms trust operations from informal arrangements into a structured and reliable system. It creates a verifiable trail of evidence that supports trustee decisions, clarifies financial accountability, and preserves the rights of beneficiaries. Well-kept records also make it easier for external parties such as banks, auditors, or regulators to recognize the trust as a credible entity. In short, record keeping is not merely an administrative task. It is a protective shield that secures the trust integrity, strengthens its reputation, and ensures that it can continue operating smoothly across generations. Key reasons accurate records matter. Maintaining accurate records strengthens the trust from both a legal and operational standpoint. It protects trustees, supports beneficiaries, and gives external parties confidence in the trust management. Legal protection. Records provide proof that trustees acted responsibly and in accordance with the trust indenture. Meeting minutes, financial accounts, and annual reports become evidence in case of disputes, shielding trustees from personal liability. Transparency. Beneficiaries can review trust records to confirm how assets are being managed. This openness reduces suspicion, prevents misunderstandings, and helps build long-term confidence in the trustees' decisions. Credibility. External institutions such as banks, auditors, and lenders rely on trust records to validate trustee authority and confirm the accuracy of financial transactions. Strong documentation enhances the trust reputation and supports smoother external dealings. Continuity. Accurate records ensure smooth operations when new trustees are appointed. A well-documented history allows successors to understand the trust's past decisions and financial position, maintaining stability without disruption. Example and why it matters. Consider a trust that owns rental properties. Trustees must maintain income statements and maintenance records to show how rental income is collected, how expenses are managed, and how distributions are made to beneficiaries. Without this documentation, trustees could face allegations of mismanagement or misuse of funds if they acted properly, even if they acted properly. This example shows why record keeping is the lifeblood of trust governance. Proper documentation provides legal defense in case of disputes, confidence for beneficiaries, credibility with external institutions, and continuity for long-term operations. In short, accurate record keeping protects both the trustees and beneficiaries while safeguarding the trust stability and reputation. Officers and management, Article 17, delegation of duties. Delegation with accountability. In an unincorporated business trust, trustees hold the ultimate authority over all trust affairs. To support efficiency, they may appoint officers, managers, employees, or contractors to carry out daily operations such as bookkeeping, property management, or administrative tasks. This delegation allows the trust to function more effectively and reduces the burden of routine responsibilities on trustees. However, delegation never removes or diminishes the fiduciary duty of trustees. Even when tasks are assigned, trustees remain legally and contractually responsible for the overall management and integrity of the trust. If an appointed officer makes a mistake or acts improperly, the trustees must still correct it. This principle ensures that trustees can enjoy the benefits of efficiency while maintaining control and accountability. Key aspects of delegation. Scope of appointment. Officers may be appointed to handle specific daily functions, such as accounting, property supervision, or general administration. By assigning these roles, trustees free themselves from routine duties while ensuring the trust operates smoothly. Unanimous approval. All appointments must be made through a unanimous trustee vote. This collective decision-making process prevents favoritism, strengthens accountability, and ensures that all trustees are in agreement before entrusting responsibilities to an officer or manager. Dual roles permitted. If needed, one person may serve in multiple officer roles, for example, as both treasurer and secretary. This flexibility can be useful in smaller trusts, provided trustees agree and maintain clear oversight to prevent conflicts of interest. Why it matters. Properly managed delegation offers significant benefits. Efficiency. Daily operations are carried out without overburdening trustees. Accountability. Unanimous approval and oversight ensure checks and balances. Flexibility. Dual roles allow smoother management in smaller trusts. Protection. Trustees remain the final authority, preserving fiduciary responsibility. By balancing delegation with accountability, trustees can streamline operations while safeguarding the trust integrity and ensuring that all actions remain aligned with its indenture. Practical applications of management appointments. Delegation in practice. In an unincorporated business trust, trustees may appoint officers and managers to handle specific responsibilities that support the trust's smooth operation. These appointments ensure that daily activities are managed effectively without overburdening trustees. By assigning defined roles, trustees create a system where specialized tasks are handled by capable individuals, while trustees remain free to focus on strategic oversight and protecting the trust mission. Examples of officer and management roles. Within an unincorporated business trust, trustees may appoint officers or managers to handle specific responsibilities that keep operations running efficiently. A property manager may oversee trust, owned real estate, collecting rent and arranging for repairs or maintenance. An accountant or bookkeeper is often tasked with maintaining trust accounts, preparing income and expense records, and assisting trustees in creating annual reports. A fiduciary officer helps ensure compliance with trust rules, assist in preparing meeting minutes, and safeguards governance procedures. Meanwhile, an administrative agent handles correspondence, official filings, scheduling, and organizational tasks that support daily operations. Each of these roles reduces the administrative burden on trustees, allowing them to focus on strategic oversight and safeguarding the long-term mission of the trust. Property manager. A property manager oversees trust-owned real estate, handling tasks such as rent collection, tenant communication, and arranging maintenance or repairs. This role ensures that income-producing assets are managed properly, while trustees retain control over major financial and legal decisions. Accountant, bookkeeper. The accountant or bookkeeper maintains trust accounts, prepares financial statements, and assists with the creation of annual reports. This role provides trustees with accurate financial data, enabling informed decision-making and ensuring compliance with reporting duties. Does that make sense? Why you'll see a lot of small business organizations, they have accountants and bookkeepers, and they probably don't even really understand, why this is a need. But most of them are operating under a trust that they didn't even create, and that's why they're being taxed out the wazoo. They don't understand. Fiduciary officer. A fiduciary officer helps safeguard compliance with trust rules and may assist in preparing meeting minutes and maintaining governance records. This role strengthens transparency and ensures that administrative requirements are consistently met. Administrative agent. The administrative agent manages correspondence, filings, scheduling, and record organization. By handling routine communication and paperwork, this role ensures that the trust remains organized and efficient in its operations. Why it matters. Appointing officers and managers for specific roles offers significant advantages. Efficiency. Routine tasks are handled by skilled individuals, freeing trustees for higher level decision making. Accuracy. Specialized officers provide precise financial, legal, and administrative support. Accountability. Clear role definitions ensure responsibilities are managed effectively under trustee supervision. Mission focus. Trustees can concentrate on strategic decisions and long-term goals, knowing that daily operations are under control. In short, management appointments create a balanced structure where tasks are delegated for efficiency, but trustees maintain ultimate authority to safeguard the trust mission and integrity. Banking Authority, Article 18, Control of Trust Finances. Trustees' role in banking. Banking is the area where the financial life of the trust takes place, making it one of the most critical functions of trust management. It is through banking that income is received, expenses are paid, and funds are safeguarded. Without a defined banking framework, a trust would lack the recognition and credibility needed to operate effectively and financial sorry a trust would lack the recognition and credibility needed to operate effectively with financial institutions. There we go. Under Article 18, trustees are granted both the authority and safeguards to manage funds responsibly while maintaining legal compliance and financial accountability. This includes the ability to select depositories, authorize endorsements, establish signature requirements, and ensure that all accounts are tied to the trust's IRS issued EIN or TIN. Together, these provisions protect trust assets, give confidence to banks, and allow trustees to carry out transactions efficiently while retaining full accountability for the trust's financial integrity. So whenever you get your EIN from the IRS, you can do it online instead of having your articles of organization with the state. You create your own articles and you would record that into your articles with your own laws. And as long as you have your own laws that are clear, they cannot assume. And that's what the government loves to do. They love to assume things. Depository selection. Trustees have the authority to designate banks or financial institutions as depositories for trust funds. This ensures that funds are kept secure and handled within the framework of recognized financial systems. Yeah, so one thing I want you to know is whenever you get your EIN and have that in there, you're going to take that to the bank with you to open up your bank account, because without that you won't be able to open up a bank account. So you definitely want that together. It'd probably be a good idea to have a minutes document typed out, and probably mostly just showing where you were appointed, but there will be a place for that too. And so you definitely want to have your paperwork in order, and just to be prepared for whenever you do go talk to these banks, because if you're not organized, they're not going to trust you. Endorsements. Trustees, appointed officers, or agents may endorse checks, drafts, or negotiable instruments on behalf of the trust. This flexibility allows the trust to process payments and deposits efficiently while maintaining proper authority. And another thing, people are hoping that they can just create a negotiable instrument and discharge their debt. What they don't understand is that most banks have their policies and procedures, and they're following someone else's laws. So they, by their laws have to make sure that you have all the information that you're supposed to have. And they're also they only have they will only accept certain negotiable instruments. So if you get out of the mindset of fighting with the banks and just try to work with them and simply ask them, what negotiable instruments do you accept? We'll just go over this one more time. Endorsements. Trustees, appointed officers or agents may endorse checks, drafts, or negotiable instruments on behalf of the trust. This flexibility allows the trust to process payments and deposits efficiently while maintaining proper authority. Signature requirements. A single trustee's signature is legally sufficient to authorize checks, drafts, and orders against trust accounts. This rule ensures that transactions can be carried out quickly without unnecessary delays, while still reflecting trustee authority. Bank protection. Banks are authorized to honor trustee-signed documents. Banks are authorized to honor trustee-signed instruments without questioning their authority. This provision protects financial institutions from liability and allows them to process trust transactions with confidence. EIN-TIN requirement. All trust bank accounts must be tied to the trust IRS-issued employer identification number or tax identification number. This not only ensures compliance with tax laws, but also establishes the trust's legal recognition as a distinct financial entity. Why it matters? The banking framework under Article 18 provides the trust with both security and flexibility by clearly defining trustee powers and banking safeguards. 1. Funds remain protected within authorized depositories. 2. Transactions are efficient, requiring only one trustee signature. 3. Banks have confidence to process trust instruments without risk. 4. Compliance is ensured, with all accounts tied to an official EIN or TIN number. This structure ensures that the trust financial activities are secure and transparent, protecting assets from misuse while enabling trustees to handle daily operations efficiently. At the same time, it upholds legal accountability, reinforcing credibility with beneficiaries and external institutions. Importance of banking provisions. Banking as a framework for trust integrity. Banking provisions in an unincorporated business trust act as both a shield and a guide for financial operations. They provide trustees with a clear framework for handling funds responsibly, ensuring that transactions are secure, efficient, and legally recognized. These rules not only safeguard trust assets, but also demonstrate to beneficiaries and external institutions that the trust is well organized, credible, and professionally managed. There you go. Without such provisions, the trust could face risk of financial mismanagement, operational delays, or resistance from the banks and creditors who may question its authority. In essence, banking provisions transform the trust from a private arrangement into a functionally recognized financial entity. They build confidence with beneficiaries by ensuring accountability, while also giving banks and other institutions the assurance that transactions are carried out under established rules. This structure strengthens the trust reputation, enhances its ability to operate in commerce, and ensures that its financial practices remain compliant and transparent. Internal control. By limiting access to trust funds to authorized signatories only, banking provisions prevent misuse or unauthorized withdrawals. This safeguard ensures that financial authority stays strictly under trustee supervision, reducing risk of fraud or mismanagement. Efficiency. Banking rules allow a single trustee's signature to authorize checks, drafts, and other orders. This streamlines day-to-day financial transactions, enabling trustees to pay expenses, transfer funds, or manage cash flow without unnecessary delays or complications. External credibility. When banks, auditors, and creditors see well-defined banking rules, they recognize the trust as a professionally managed and reliable entity. This credibility makes it easier to establish banking relationships, conduct transactions, or even secure financing when necessary. Every transaction leaves behind a documented financial trail, supporting accurate bookkeeping and Every transaction leaves behind a documented financial trail, supporting accurate bookkeeping and annual reporting. This ensures transparency, strengthens accountability, and provides proof that trustees are fulfilling their fiduciary responsibilities. Example in practice. Consider a trust that is actively managing investments such as stocks, bonds, or other financial assets. In these cases, timing is critical. Market opportunities can appear and vanish quickly. Banking provisions allow trustees to act without delay, ensuring that financial opportunities are not lost. 1. Prompt transactions. Trustees can buy and sell assets quickly, avoiding losses caused by administrative delays. 2. Authorized endorsements. All checks, drafts, or financial instruments require proper endorsements, ensuring transactions are valid and secure. 3. Record-keeping trail. Each transaction leaves behind a clear record, which supports transparency and future audits. 4. Balanced oversight. While efficiency is maintained, trustees remain accountable for every financial action. And I just want to be clear, it says trustees remain accountable for every financial action. That doesn't mean that it's going to come out of their own pocket, anything financially. So this balance of efficiency and oversight allows trustees to manage investments responsibly while safeguarding the interest of beneficiaries. It not only shields trustees from liability, but also preserves the trust integrity and credibility in its financial dealings. That's exactly what I just said. Okay. Summary and next up. Summary, records and management. The provisions on records, management, and banking are designed to create a well-documented, effectively managed, and financially secure trust. 1. Records. Trustees must maintain minutes, financial accounts, beneficiary registers, and annual reports. 2. Officers and management. Trustees can delegate tasks to officers or managers, but retain financial responsibility and oversight. 3. Banking. Trustees authorize bank accounts, control financial instruments, and safeguard funds through trust-based signatories and EIN registration. This balance of efficiency and oversight allows trustees to manage investments responsibly while safeguarding the interest of beneficiaries. It not only shields trustees from liability, but also preserves the trust integrity and credibility in its financial dealings. Coming up next, in the next lesson, Business Transactions. This lesson will explore how trustees conduct trust business, including holding and managing assets, entering into contracts, and engaging in lawful business activities under their granted powers. It will highlight the wide scope of trustee authority in executing transactions while maintaining fiduciary responsibility. So, that concludes today's lesson. Again, this is Trusted Academy. My name is Caleb Mills, and my email address is caleb@trustedacademy.net, and my phone number is 618-313-1860. I would like for anyone who is interested in learning how they can get more clients and how they can get more sales through their website setup. A lot of people don't realize that they're missing out on a lot of opportunities, or maybe you do recognize that you're missing out on opportunities and don't know how to fix that. But I definitely have a resolution for you. So if you're interested in that, please reach out, and I would love to tell you more about that. So thanks again for being here, and this is Trusted Academy. Bye.